So the way I view any new client is I want to build out an investor matrix. I want to understand what their investor matrix looks like. Investor matrix for us is understanding these key elements of a transaction. And I'll read them out to you. What is the client's preferred strategy? Now, that's the first thing I want to know. Now, in property investing, there are multiple strategies, but the way I simplify it into two strategies is, are you wanting to be a passive investor? Passive meaning buy, hold, don't have to worry about doing anything to add value to the property, or an active investor whereby you're adding value and you're forcing growth or cash flow. Then there's obviously a combination or a hybrid between the two. So step one, I want to ask you, when I'm building an investor matrix will essentially be a sheet, a table we fill out together to work out your blueprint. Once we have your blueprint, that tells us where to buy and what to buy. So this is really important that you understand how to build out your own, or you engage somebody to build it out. So first thing I want to understand from you is what strategy suits you better. So I'll ask you, Dave.
Yeah, let's do it. Let's do an active one.
What's your, if you were going to buy your first property, what would you prefer? To buy something like a boutique apartment where you don't have to do any work to it, there's minimal land, you don't have to worry about anything, set and forget, or it could be a freestanding house that's more modern, doesn't need any work? Or would you prefer something on an established home that was built sub 2000s, you could add value to through a cosmetic renovation, you could even maybe build a granny flat which is structural, and you can increase value, plus you can increase cash flow. For your first property, understanding that you're a self-employed, somebody that's career focused and may not have much time to invest in property, what out of the two strategies do you feel for you makes more sense?
Well, I'd go set and forget because I don't have the time to.
So you've just confirmed to yourself that a passive investment is better suited to you than me. The reason why that's important is because you may hear other property investors or buyer's agents say, here's my strategy and here's the best strategy in the marketplace.
They try and force it upon you regardless
but for you, it doesn't suit you. Like I could say that buying a house and adding a granny flat is the best strategy out there, and you could make $100,000 in instant equity, plus you'll have good cash flow.
I'd like to do that, but I can't do that right now.
But for you, it doesn't suit your lifestyle at all, and it's the wrong strategy. So you've confirmed that, not me. So what strategy suits you? More passive. So we write passive. Okay, next question. Dave, for the duration of time we're going to hold the property, do you think you're going to be somebody that's short-term, medium, or long-term? Now, a short-term buyer would be somebody like a developer who's going to go an active strategy, buy, do a renovation, flip it. A medium could be you're going to buy this property, sit on it, let the value increase over time. You might do a speculative play where you buy more Perth or a marketplace where you're going to have really good short-term growth. Then you're going to cash out and go do another thing. Or long-term could be you're going to buy, hold, set and forget, hold it for say 10 plus years, and we're going to use the equity that builds up in the property to roll over into another property.
Well, even the way you asked that question, it was like a suggestion almost. But yes, it's number 3.
Long-term.
Yeah. I'd always hold it for 10 years.
So we're going to do a long-term, passive, long-term. Then the next, so long-term is important, right? Because it's going to influence what marketplaces we buy. Because I'd much rather look at a marketplace that has consistent long-term growth as opposed to fluctuations in price movements. So it could perform really well over 3 years, but then year 4, 5, 6, it's stagnant. And if we look at over a 10-year period, what marketplace is going to perform better, it's going to influence where you buy. So once we understand those pillars, that's okay. What's more important to you, cash flow or capital growth? So that's where we come back to, I'll ask you a prime question, which is how much money, what's your purchase price? So you have spoken to a broker. Let's assume your purchase price is $700,000. So it's $700,000. For $700,000, Dave, what's more important to you, cash flow or capital growth? So where we go back to your cash flow analysis, how much do you feel per week you could forego out of your pocket to hold the asset?
Well, let's go with the $100 example that you gave before.
$100, we're going to assume that $100 means you're going to have to buy a property with about a 5% yield. Give or take. Like we're just giving an example. That means you're wanting to focus on a higher cash flowing asset, which means that if we buy a property that's got one cash flow, meaning it's a house that's not a granny flat, it's just a normal house. A dual income would be like a house and granny flat where there's 2 forms of cash flow. A single dwelling cash flow, a very strong yield is around 5%, 4.5%, 5%. Once you start exceeding 5%, that's when you're having declines in growth on average.
So conversely here, I know you're wanting to put the ball in my court. You're not trying to force a strategy onto me, but is there advice you could give me here, because I'm not completely sold on this, right? So I might adapt my living situation a little bit if you thought that the capital gains avenue was better for me. So the reason I say $100 now is because I'm paying $400 a week in Leichhardt plus 2 gym memberships, groceries, everything like that.
Yeah.
I got a lot of expenses when it comes to my productions and things like that.
Perfect question. So the next question I was going to ask you is capital growth.
Yeah.
What's more, like, then we start looking at capital growth. So I will show you with capital growth, the more capital growth you want to target, on average, there's an inverse correlation between growth and yield.
Gotcha.
Example, like guide. That's not always the case. But what I could say to you, Dave, is okay, $100 a week you can forego now. But if I was to present a property that was a 4.5% yield, but grew a whole percent greater each year, would you have any leeway there? Would you have any flexibility?
Yes, because that's where I'd like shift my situation. Whereas like I might go eat shit, live in mum's granny flat for a little bit.
So living in mum's granny flat at a 5% yield, there's going to be 3 suburbs in Australia that have maximum growth, passive, buy, hold, 5% yield, maximum capital growth that we'd consider for that purchase price. Now, if you're going to increase your flexibility, we've gone from 3 suburbs to 5 or 6 suburbs. And we're changing also potentially some asset types we can consider as well. So we're just increasing the bandwidth. We're not subtracting or minusing. We're just giving you more capacity. So capital growth, I want to get an understanding. Then locations. Do you have, as a buyer, any location preferences? Now, because you're not an active or an active investor or a developer, where you buy shouldn't have any relevance. What should have relevance is the performance that naturally occurs. So I'm going to assume, based on that you'd be open to looking at any locations we suggest, given the right data.
Yeah, wherever.
Perfect. So what we'd want to look at in terms of locations: vacancy rates, supply and demand ratios, capital growth rates, rental returns, quality of assets, frequency of property selling in a point in time.
Yeah.
So then once we understand locations, Dave, do you have any special considerations or special conditions? For example, did you want to be somebody that does, like, did you have any special requests when it comes to buying the property? Some people might want to look at NDIS properties. Some people want to look at properties that is only a freestanding house, not an apartment. Some people have their own special things that we want to lay out so I can problem shoot with them. For you, do you have any preferences if you bought a house or an apartment or a townhouse?
No.
Okay, cool. If you have no preferences,
But I know the benefits from talking to you about the different property types, like, you know.
So I'll give you an example.
Sorry,
if we were to buy it for $700,000, we could buy in the best suburbs in Newcastle an apartment. For example, Merewether is the best suburb in Newcastle. It'd be like the Bondi of Sydney. Merewether is like that of Newcastle. We could buy in a 10 out of 10 suburb where there's strong, good affluence, good lifestyle drivers, close to the beach, good proximity to CBD, etc., for $700,000. Or we could buy in, say, the Ipswich region, like a Redbank Plains of Brisbane, which is, say, a 6 out of 10 relative, hypothetical, like just giving you an example so it stands out in terms of the quality of suburb, but you've got a freestanding house.
Gotcha.
Now, the performance of these two could be similar, but you as an investor or a buyer may prefer a marketplace where you've got different quality of tenants.
That would be a consideration that would be important, because for me it's all about, I just don't want headaches. There's enough. Everyone has headaches in their life. They don't need that with with their largest asset. There's going to be enough, Like my housemate talks all the time about how this thing or that. He owns 3 properties, and shit goes haywire with them all the time. And even that a little bit, is a bit discouraging at times. So the last thing I want is to be buying in an area. And I don't mean this in the wrong way. It's just the fact, I'd want to be attracting a good quality of tenant. You know what I mean?
And
not a party house.
Not a party house.
Yeah.
And look, the reality is both locations should do well, but some people just have a innate preference. And if we don't address it up front, you could get funny when we go to do a deal and you're bringing that issue up too late as opposed to early in advance. So it's good to get it out. Now, an example is a client like Ryan, who can add value to. He's a tradie, doesn't have time to do a full-on reno or active approach, but he in 2-3 years time might be able to go up to the apartment in Newcastle because it's closer. He could drive there as opposed to fly to Queensland. And do like cosmetic work like paint, carpet, flooring, insert a kitchen,
I thought you were talking about the freestanding property. That's what I said. Granny.
That's where, again, the apartment play could work perfectly. The location can work perfectly for people. Therefore, the apartment strategy, you can only do the apartment strategy because you can't buy a freestanding property. Whereas in another marketplace, you can afford a freestanding property. So you've now built out a matrix, and from there we can look at, for 700 grand, assuming we need a rental yield of 4 to 5%, what are the marketplaces we could buy into? Then we look at those marketplaces in New South Wales, Queensland, Victoria, Perth, etc. Then we look at those marketplaces. Then let's say we pick the top 5 suburbs in each region. Then with the top 5 suburbs, we go and do the location research. What's the historical growth rates look like? What are the vacancy rates look like? What do supply and demand ratios look like? What are the quality of properties in that area look like? What's the frequency of stock? Then we then understand, out of those, say, 20 suburbs, what are the top 5 suburbs we're going to focus the search on? We've just built this out where we're no longer like, I don't have a hidden strategy. I don't have any.
It's all on the table.
It's all, there's no conflict of interest. It's like, for your situation, these are the best opportunities for your situation. And then you have confidence that without me, you could essentially go into a marketplace that I've suggested and get a similar result.
Even if I haven't been there before.
Even if you haven't been there before. Now, the reality is your ability to find that property, negotiate, do a deal compared to me is different, but on average, you could at least still get a desired outcome. So that's why we do an investor matrix.
That's huge, man.
Any questions on that?
No, because I was asking stuff along the way that, applied to me. It's all pretty advanced, everything that you're talking about, at least for me, because for the consumer, it's a lot. Let's just disregard that for a second, because you've got here that it says advanced property investment strategies, as if the stuff we've been talking about isn't advanced enough. But is there levels to this?
So we can start talking about different entities. So you may have a couple properties in your name, then want to still build a portfolio, but you're tapped out in lending in your personal name. So you look at doing a self-managed super fund purchase, where when you borrow money in a self-managed super fund, it's completely separate to what you currently have. That's another strategy.